Before armies marched and crowns fell, before flags were raised or lowered, there existed a quieter force that moved without banners, without speeches, and without resistance. A force so ordinary it appeared harmless, yet powerful enough to steer entire civilizations without ever appearing to rule them. And this story does not begin with conquest or invention, but with a simple, almost invisible adjustment to how money itself was treated. An adjustment so subtle that most people living through it never noticed the moment when control shifted, only the consequences that followed much later, when economies that once felt stable began behaving in unfamiliar ways, responding less to human intention and more to mechanical necessity, as if guided by rules no one remembered agreeing to. And to understand how this happened, we must return to a time when money was still tangible, when wealth was measured by weight, when trust was personal, and when a small banking practice quietly transformed from a convenience into a system that reshaped power itself. In medieval and early modern societies, economies were constrained by physical limits. Coins had to be mined, minted, transported, guarded, and verified, which meant growth was slow, trade was local, and rulers faced constant scarcity. Wars were expensive, administration was fragile, and taxation was politically dangerous. So when merchant banks emerged in commercial centers like Florence, Venice, Amsterdam, and later London, they initially served a narrow function, safeguarding deposits, facilitating trade payments, and reducing the risk of carrying metal across dangerous roads and seas. And this service was revolutionary, not because it created wealth, but because it concentrated trust. Merchants began leaving gold and silver with bankers not for profit, but for safety and convenience, receiving written claims in return, claims that soon proved easier to exchange than the metal itself, because paper traveled faster, weighed nothing, and relied on reputation rather than force. Over time, bankers noticed a pattern that seemed obvious only in hindsight. Depositors almost never came all at once to reclaim their metal. Withdrawals were predictable and partial, which meant most of the gold sat idle in vaults while trade expanded around it. And this observation gave rise to a practice that would quietly alter economic reality. Bankers began lending a portion of deposited money to borrowers, issuing new claims on the same underlying metal, as long as they retained enough reserves to meet expected withdrawals. This practice appeared rational, efficient, and even beneficial. It funded commerce, smoothed liquidity, and earned interest without visibly depriving depositors of access to their funds. Yet beneath this efficiency lay a transformation of money itself, because now more claims existed than metal to back them. Money had become elastic. As this system matured, it aligned perfectly with the needs of states. Monarchs perpetually short of funds discovered that borrowing from banks was less politically risky than raising taxes, especially during wars. Banks in turn discovered that lending to governments was safer than lending to merchants, because states could tax future populations to repay debts. And thus, a feedback loop formed. Governments relied on banks to finance expansion, banks relied on governments to guarantee repayment, and the banking practice of lending against fractional reserves became embedded into public finance, normalized, regulated, and eventually protected by law. What made the system so powerful was not deception, but incentives. Depositors wanted convenience and perceived stability. Bankers wanted profit and scale. Rulers wanted money without rebellion, and none of these actors needed to fully understand the long-term consequences for the system to function, because each decision was locally rational yet collectively transformative. As credit expanded, economies grew faster than physical resources would otherwise allow. Trade networks widened, populations increased, and specialization intensified. But this growth was no longer anchored solely to production. It was anchored to confidence. As long as trust in the system remained intact, money flowed, investments continued, and debts rolled forward. The psychological dimension of this transformation was subtle but decisive. Money ceased to be seen as a finite store of value and became a circulating promise. Individuals and institutions adjusted behavior accordingly. Long-term obligations felt manageable.
Risk felt distributed, and responsibility diffused across layers of contracts and intermediaries. Decision makers became increasingly insulated from immediate consequences because losses could be deferred, refinanced, or absorbed by the system. And this encouraged larger projects, larger wars, and larger debts, all justified by the belief that future growth would resolve present strain. Over centuries, this banking mechanism evolved with refinements. Central institutions emerged to stabilize reserves, manage confidence, and act as lenders of last resort, further reducing the visible risks of the system. Crises did occur, bank runs, collapses, currency devaluations, but each response strengthened the framework rather than dismantling it, because the alternative, returning to hard scarcity, was politically and economically unthinkable for societies accustomed to expansion. And so the system endured, not because it was flawless, but because it aligned power with predictability. Those who controlled credit allocation gained influence over which industries grew, which states survived, and which ambitions could be financed, often without issuing commands or enforcing laws, but simply by adjusting access to liquidity. The consequences of this arrangement were profound and uneven. Economies became capable of extraordinary growth, but also vulnerable to systemic shocks. Cycles of expansion and contraction intensified. Wealth concentrated around financial centers, while peripheral regions remained dependent on credit flows they did not control. And when confidence faltered, the effects rippled outward, affecting employment, trade, and social stability far beyond the banking halls where decisions were made. Yet responsibility remained diffuse. Crises were framed as failures of confidence, miscalculations, or external events, rather than inherent features of a system built on leverage. Over time, the original simplicity of the banking trick faded from public awareness. Few people thought about reserves, claims, or balance sheets. Money simply worked until it didn't. And when disruptions occurred, responses focused on restoring function rather than questioning structure, because the system had become inseparable from everyday life. Wages, savings, pensions, and state budgets all depended on its continuity. The long-term outcome was not a single collapse, but a permanent condition of managed instability, growth punctuated by crises, stability maintained through intervention, and power exercised indirectly through financial architecture rather than overt rule. And this arrangement proved remarkably resilient precisely because it operated quietly, without spectacle, without ideology, and without requiring universal understanding. In the modern era, the same principles persist in more abstract forms. Money exists largely as digital entries, credit moves at unprecedented speed, and economic decisions scale globally. Yet the foundational mechanism remains recognizable, a system built on trust, leverage, and the expectation that future productivity will validate present claims. And while the details have grown complex, the underlying lesson remains simple and enduring. When societies allow promises to function as money, they unlock extraordinary capacity, but they also bind themselves to systems that must constantly be sustained, managed, and believed in. Because once an economy is organized around expandable credit, control no longer requires force, it requires stewardship of confidence. The quiet power of this banking practice was never that it enslaved economies, but that it reordered priorities, shifting focus from physical limits to financial signals, from immediate cost to deferred obligation, and from visible authority to systemic influence. And in doing so, it reshaped how empires rose, how wars were fought, and how prosperity was measured, not through conquest alone, but through balance sheets that decided what was possible long before events unfolded, leaving behind a world where the most consequential decisions are often the least visible, and where the mechanisms that guide entire economies operate not in moments of drama, but in the steady, silent expansion of trust itself.